Investors now predicting the Fed may be finished with rate hikes for the rest of the year. Joining us now, Grant's interest rate observer, Jim Grant. Jim, it's so good to have you on the show. Welcome.
Well, thank you, Morgan. Nice to be here.
I do want to start right there. What did you think of Powell's comments today?
Well, I thought, like every Delphic prophet, he was just ambiguous enough, but he said something that I don't think is borne out by what the Fed likes to call the data, and that is he said that monetary policy was restrictive. Now, there are 4 or 5 indices of financial conditions, and 4 of the 5 say that notwithstanding this rise in rates and QT and the like, that conditions in finance generally are accommodative. So it makes you wonder what stringency would feel like, because certainly on a kind of a tactile basis, it does feel as if things are rather taut. But in interesting comparison to the 1970s, when these same indices or their predecessors were flashing tight, and nothing like that today. So the problem, Morgan, may not be so much the 5%, but rather the many years preceding of 0% that introduced a fragility in the economy that 5% is now testing.
Yeah, the quest for yield over so many years of low interest rates, we know tends to turbocharge risky behavior.
Yes.
How key is it going to be then to see the Fed hold with higher for longer? Because to your point, we saw this with consumers, with the housing market, with mortgages, for example, where they locked in or they refied on low mortgage rates. We saw it in corporate America, too, where they locked in on low interest rates on their debt. At some points, that starts to roll over. So how much does time matter here?
Matters a great deal. You're starting to see things already that exactly suggest what you described as the characteristic consequences of a very low kind of money grows on trees kind of interest rates. There's a company called Convoy, which is a logistics and trucking company that had the imprimatur of Bill Gates and Jeffrey Bezos, and it was once valued in the private equity world, or the venture capital world, rather, at $3.5 billion, $3.5 billion. It had 1,500 employees, and Bloomberg moved a story today saying that they were shutting down operations because they could find no one to buy them. And the CEO of Convoy Inc. said that he cited stringent or contractionary capital markets as one of the reasons for their shutting down. And, at the margin, that is happening not yet far and wide, but it is beginning to happen. And I think as time goes on, you'll see much more of it. But again, yeah.
Jim, Mohamed El-Erian was on Squawk Box this morning arguing that the Fed is too data dependent at this point and needs to flat out say we're done, because what do they know about the future looking backward at data anyway? What do you think about that? And is there a particular danger now in using backward-looking data to kind of affect what's happening 18 months out?
Well, the data are revision prone, and almost by definition backward-looking. Certainly they're historical. And one shouldn't be utterly dependent on them. Jay Powell, I think, in his summertime speech at Jackson Hole, said something like the Fed is navigating by the stars under cloudy skies, which I think is most apt. So you need not just the data, but you need a framework, a theory. You need a way of thinking. And I would submit to you that a common sense approach might be helpful. And for example, you can reason that if you have been suppressing interest rates, you being the central banks collectively worldwide have been suppressing them for the better part of 10 years, and if at one point, extreme point, some 16 trillion of securities were priced to yield less than nothing, lowest rates in 4,000 years, if you please, of recorded rate history, in those circumstances, you'd expect that the proverbial beach ball held underwater would pop up again and not just stop at the surface, but rather shoot a little bit in the air. So I think that's some of what's happening. And, so I agree with Mohammed that one can't be a prisoner to these data. You have to have I don't know, have to some grounding in financial history and some grounding in common sense, I suppose, too.